Good afternoon, friends. Today I am live with our original topic, accounting preliminary aspects and the rules of debiting and crediting. And today I am focusing on especially the recording of transactions. So friends, in the last discussions, in the three discussions, I have given you a preliminary idea about what accounting is. Accounting is a process of preparation of statement and statement of events. What is event? I have already told you. Event, anything that happens is an event. And recording of event needs categorization of the events. All the things happening all over the world are not supposed to be taken into account for our purpose, for the purpose of our recording. I will record only those which are important to me. As we go on writing diary, we individually give the stress on the events which have been having or which are having proper implication on my life and living and my activities. So that is importance. Now we have to generalize the importance, and the generalization calls for that we should trace on all the financial events. So events are divided into two parts. One is recordable events and the other is non-recordable events. Non-recordable events are out of our jurisdiction. Recordable events, we should pay proper attention to that. And the recordable events are of two types. One is having some financial impact and having no financial impact. The events, recordable events which are of no financial impact, we should not consider for the purpose of our accounting and finance and economics. Because with the students of economics, with economics and commerce, we should pay attention to only those events which are concerned with exchange of money and changes in the financial position of the parties concerned, and that is known as transaction. Yesterday I have given the definition again. A transaction is an agreement and arrangement of exchange of goods and services that is measurable in terms of money and which results in change in the financial position of the parties concerned. Now, with this thing, I have told you that there are two aspects of transaction. One part is receipt, lend, to receive and to give, and this will be receive and give receipt will be taken into two on the two bases. One is debit and the other one is credit. D-E-B-I-T, debit. The word has come from the Latin, it has Latin origin, debitum, and credit means credit. It has again got the Latin origin, creditum. Now what is credit and debit? While recording, when the first step of recording transaction, I have told you yesterday, the first step that occurrence of an event, occurrence of a transaction. If there is no event, if there is no transaction, though there is no question of recording. When the transaction, when any event takes place, we should see whether it is recordable, these are financial events, which are subject, which are transactions or not. We will record only the transactions. Only the transactions are recorded by us. Clear? And then, while recording, we have to find out what are debits and what are credits, because accounts are segregated into two parts. One is debit side and the other one is credit side. Basically, the left side is regarded as the credit side. Right side is taken as the credit side, and left side is regarded as the debit side. Anyway, left credit, nothing is considered to be as left and right now. Only find out the debits and credit, and that is the rules of debiting and crediting. Finding out the rules of finding out the debits and credits of each and every transaction, we will go on recording. Clear? So that is the primary thing I have discussed, and now I am going to take up a detailed discussion on some events and how to find out the debits and credits. Now I have given a list of the events and transactions, and you as a students of commerce, as students of accounting, you have been asked to find out the rules of debit, find out the debits and credits of the following transactions. Following events and transactions. These 11 events and transactions are here. You have to find out whether they are event, or whether they are simple event or whether they are transactions. Now, see, first one. Mr. X is appointed as the cashier at a salary of rupees 20,000 per month. Mr. X is given appointment as the cashier. Is it a transaction? Certainly not. Okay, why not? Because the man has been given the appointment. He has been given the appointment later. He may be given the appointment later. He has been chosen to serve our organization as a cashier, and he will be given 20,000 per month. But this particular happening is an event, but it is not a transaction. Why not? Because it affects no change in financial position of the parties concerned. Here the prior salary will be 20,000 per month, and it will be taken into account when he will be given, when he will be paid the amount. When he will be paid the amount, what we will see? What comes in? Nothing is coming in. Then what is going out? Cash is going out. So when the payments will be made, then it will be to cash carry. Cash is giving out, so cash carry. Okay, 20,000. Now what is debit? I am not getting. Nothing is coming in. Say for what purpose? It is for the purpose of salary. Okay, so that will be the recording, but it would be done at the time of payment of this amount. But right now he has been given the appointment, so it is not a transaction and it needs no recording. Clear? Now take these four parts, these four numbers, 2, 3, 4, 5. Yesterday I have told you, purchase goods for cash rupees 2,000. What is our first rule? Our first rule is what comes in debit. What comes in debit? Debit. What goes out? What goes out? Credit. Okay. So what comes in? Purchase goods. Goods are coming in, and what is going out? Cash is going out. So cash account is credit. Okay. Now take this one. It is solution of 2. So we should say that goods debit and cash credit. Okay, cash credit. Goods debit, cash credit. How much? 22,000. Okay. Now consider the case of 7. 7. What is it in 7? Sold goods for cash rupees 8,000. What comes in? Cash is coming in. So cash is debited. Cash debit. And goods credit. Goods credit. How much it is? 8,000. Okay. Now you see what I have told you last day, that we should not write goods. We may write goods, but this goods account, when the goods are purchased, we record it as purchase. Why? I have told you yesterday. Again, I am taking it into account. And when the goods are purchased, instead of goods account, we write purchase, and when goods are sold, we instead of goods, we write sales. So purchase is always debit, goods, sales is always credit. Okay. Now what for this is? Yesterday I have told you, today I am taking it again in some greater detail. Goods in business. The goods or the materials, whatever we say, the materials which we use in the business are of 3 types. Okay? Are of 3 types. There are some goods which are purchased and sold. That is, this is the goods which is regarded as the trading goods. The trading goods are, which goods are trading goods? Trading goods. Trading goods are those goods in which I am dealing in. So trading goods. Trading goods are the goods, it is the goods of our basic business. And there are some goods which are not trading, but that helps in our activities. Yesterday I told you, I carry on the business of jute. So I purchase jute, I sell jute. Now jute is what? Jute is my trading goods. Okay? Jute is my trading goods. But for carrying my trade, I have to purchase. I have already purchased some machineries for the purpose of processing, for the purpose of industrial activities. I have purchased some furniture for my office. Okay, I have purchased a motor car for our office. I have purchased some trucks, some lorries for carrying on the goods from one place to the other. So these are also goods. But these goods, there is a difference. The basic difference is that the jute in which I am dealing with, it is used only for once. It is used only for once. The jute I am purchasing right now is going out, it is being sold. Okay, so it is only once. But the lorry of the truck that I have purchased, it is used repeatedly. So it is known as fixed goods. Okay. So there are two types of goods. One is trading goods. Trading goods is a good with which I am carrying on my business. That is my business goods. And other ones are fixed goods which are used repeatedly. So this is known as recurring. Recurring. It is purchased and sold. It is purchased and sold. So it is recurring, or it is one time. So fixed goods are basically regarded as assets. Okay, fixed goods are regarded as assets, and this is known as current assets. So fixed goods are fixed assets, assets fixed. Okay, fixed assets are there, and this is known as current assets or current goods. Current assets. Current assets means which are used recurringly, repeated. It is used for one time, and it is purchased many times during a particular period, and it is sold out repeatedly during a particular period. So it is our recurring. Whenever we are purchasing current assets, that is, we write purchase. Whenever we sell current assets, we write sales. But whenever, now take that example of purchased machinery for respective. What is coming in? What is coming in? If you write purchase account, purchase debit and cash credit. Is it right? Is it okay? Is it okay? Certainly not. Why? Because it is not our trading goods. It is our fixed asset. So here we should mention the name. What is being purchased? Machinery account debit, machinery cash credit. Clear? So we have learned what thing? Whenever we purchase trading goods, we write purchase instead of goods. Whenever we purchase any asset, we write down the name of the assets. Say we have purchased some furniture. So what it would be? Furniture account debit to purchase account to cash. Whenever we are purchasing some motor lorries, so motor lorries account debit and cash, whatever it is, UTV, irrespective of bank account will be credit. So in that way, okay. In the same fashion, say sold furniture for 25,000. What it would be? Cash account. Cash is coming in. Sold furniture. What is happening? What comes in? Cash is coming in. What is going out? So furniture is going out. So furniture account will be carried. Clear? Any problem? So this is very, very important. There is another thing. There is another thing that is known as stationaries. The stationaries, I think you know the concept of stationaries. Stationaries are all the goods which are used for our office work, for writing, for accounting, and all other related activities. And these stationaries are, you see, copies, pen, pencil, eraser, sharpener, stapler, puncher, okay, all these are the stationaries. And in that case, these are not trading goods. This is also one, it is one for all. Trading goods is used once for all. Fixed assets is used repeatedly. And stationaries are used once for all. Some part of the stationaries are used once for all and some part are repeatedly. But whatever it may be, the stationaries are written in its name, stationery. If an organization purchase stationery, if the transaction is given, purchase stationeries for cash, so what you will do? Purchase account debit to cash? Sorry, no. You will write what? Stationeries account debit to cash. Clear? So this is a very, very important aspect, friends. Each and everything I am giving you, please bear it in your mind, because each and everything will help you understanding the recording aspects of your accounting. Okay, the recording aspect. So what we have seen, the goods in business are of three types. One is trading goods, and the other is non-trading goods. It is fixed in nature, non-trading. So we are not trading with this, non-trading with this, and this is fixed in nature. And these goods these goods give us the service for many times to come. So it is used permanently, and they are known as asset, fixed asset. So this fixed asset, whenever it is purchased, in the name of the asset is used. Whenever we are purchasing motor lorry, we are writing motor lorry account debit to cash or bank, whatever it may be. Or whenever we are purchasing any machine debit to cash. Whenever we are purchasing any furniture debit to cash. And if they are sold out, they will be credited and cash will be debited. But whenever we are purchasing trading assets, that is trading assets are the assets in which we are carrying our trade, or that is our trading assets. Whenever we are purchasing, purchase account will be debit, and whenever we are selling it, sell account will be credit. Okay, so this is very, very important discussion. Friends, please bear it in mind. Okay, please bear it in mind. Then comes just I am making some specific discussion on cash and credit transactions. I have told you the transactions are of two types. Okay, cash transactions and credit transactions. Yesterday I told you cash transaction refers to the instant payment. You are getting the goods and making the payment. That is cash transaction. And credit transactions are those when a transaction is completed, payment is made, goods are delivered today, but the payments will be made at some later date. Okay, so that is known as credit transaction. There is also cash credit transaction. Cash credit transaction, there may be cash credit. Say you are purchasing mobile and it costs rupees 40,000. You are making a cash payment of 12,000, and the remaining part will be paid later on. So this is known as cash credit facilities. Okay. Now I am just coming to this part only. Okay. Cash transaction and credit transaction. Consider it. Now how do you find out what is cash transaction, what is credit transaction? See, purchase goods for cash rupees 2,000. What is very, very clear. What we should do? We should first apply the rule. What comes in, what goes out. Anyway, clear? Now purchase. So we would say goods account debit or purchase account debit. Okay, purchase account debit and cash debit. Clear? So far as problem number 2. So it is purchase account debit to cash, because it is clearly stated that the goods are purchased for cash. The goods are purchased for cash. So what is coming in? Goods are coming in. So goods we are purchasing goods, so it will be purchase account debit and cash will be credit. Now come to problem number 3. Problem 3. Purchase goods for rupees 5,000. Nothing is stated. Whether it is cash transaction or credit transaction. Then what will you do? Here you have to assume. Here you have to assume that it is cash transaction. Why? I am coming to that one. Before that, come over here. Purchase goods on credit from Ram. Here, purchase goods are coming in, goods account debit, that is purchase account debit. What goes out? Nothing is going out. Nothing is going out, right? Then, second rule, you should apply the second rule. Receiver debit, right? Receiver debit, and give her credit. Now, purchase goods on credit. Goods are coming in, so purchase account debit, and cash is not being given right now. So it is a credit transaction. Then who is the giver is credit? Who is giving the goods? The goods are being given by Ram. So Ram account to be credit. And this Ram is your creditor. Okay? This Ram will be your creditor. Now take these two examples. So example number 2 and example number 4 are absolutely clear in their presentation. Okay? Yeah. And now in the question, in their respective question itself. But here is some problem. Purchase goods for rupees 5,000 and purchase goods from Jyoti rupees 6,000. Consider this two. Here nothing is stated whether it is cash transaction or credit transaction. And here also, purchase goods from Jyoti rupees 6,000, it is not also given whether it is cash transaction or credit transaction. So we should, I have already told you yesterday that accounting is a social science. Basic principles of science, accounting has been developed through the process of use, repetition in use, convention and tradition. So conventionally what we say, when it is written that purchase goods for rupees 5,000, nothing is stated whether it is cash or credit. But again, purchase goods from Jyoti for rupees 6,000, not at all stated whether cash or credit. When the name of the person is given, in this case, in this doubtful case, there may be double meaning, double thoughts. Then here we should consider when the name of the person is given, it is regarded as credit transaction. When the name of the person is given, it is regarded as a credit transaction. And when the name of the person is not given, then it should be taken as cash transaction. Clear? So first, what do you say? Purchase goods for cash, no problem. Purchase goods on credit from Mr. Pashu Khadu, no problem. But problem is there when purchase goods for cash, nothing is stated, cash or credit. Purchase goods from someone else, name is given, but nothing is stated whether cash or credit. Then we should take it in favor of credit transaction because the name of the person is given, but not for cash or on cash, nothing is stated. But when nothing is okay, so this is the thing you should take into account. And therefore, now, so the question number 2, purchase goods for cash, purchase account debit to cash. Purchase goods for rupees 5,000, we should consider it in favor of cash transaction. So purchase account debit to cash. Purchase goods on credit to Ram, from Ram. Sorry friends, it is from Ram. Purchase goods on credit from Ram. So it is clearly stated that it is a credit transaction. Goods are coming in, so purchases should be debit and credit. Giver is the credit. Who is the giver? Ram is the giver. So goods account debit to Ram. Then purchase goods from Jyoti, not stated whether it is cash transaction or credit transaction. We would consider it in favor of credit transaction. So purchase account debit or Jyoti account debit. Then comes the question problem of 6. Purchase machinery for rupees 5,000. What is that? Machinery is coming in. Here we must not say purchase account. So purchase should be considered when the goods are purchased, but machinery is your fixed asset. So machinery, the name of the asset should be considered. That is machinery account debit to cash. Then sold goods for cash rupees 8,000. No problem. What comes in? Cash is coming in. So cash debit or what goes out? goods are going out. So it is, instead of good, we like sales. And the sold goods forecast, it is clearly stated that it is cash transaction. Considering sold goods forecast will be 20,000, not clear whether it is cash transaction or credit transaction. But the name of the person is not given, so we will consider that in favor of cash transaction. So cash account debit to sales. Now sold goods on credit to selling rupees 12,000. So what is happening? What comes in? Nothing is coming in. So what is going out? Goods are going out. So it is sales. This is going on. Then receiver should be debited. So selling account debit. Selling account debit. Then sold goods on credit. Sold goods to to be 11,000. Not stated whether it is cash transaction or credit transaction. Our conception, we should consider it as a credit transaction. As the name is given, but not it is stated whether cash transaction or credit transaction. So it would be Panchu account debit to sales. Panchu is the receiver, sale will be the sales will be credit. In sold furniture for rupees 25,000. So sold furniture for rupees 25,000. What comes in? Cash is coming in. And what is going on? Furniture is going out. So furniture account is credit. So this is these are the basic things. So here today I have tried to give you the trace on the conception regarding the assets. So for recording properly, you should first know what are the different types of assets. Assets used in our organization are of three types. One is current assets, in which we are paying on what debt, and the other one is fixed assets. Current asset is used only once. Okay. And so fixed assets are used repeatedly. So whenever we are purchasing current assets, we say purchase account debit. Whenever we are selling it, we say sell account debit. Whenever we are purchasing asset account debit in the name. And whenever we are selling the assets account will be credit. Clear? Whenever we are purchasing stationery, what will be purchase stationery for 5,000? What is to be? Stationeries are coming in. So stationery account debit. Stationery account debit to cash account debit. Clear? So this is the basic way of finding out the debits and credit of any transaction. Clear? So this is all about the basic rules of accounting. This is all about the basic rules of accounting. And now in the process, I will let you know that some critical element of generalizing is making debits and credits. And that will be covered tomorrow onwards. Here, and tomorrow our topic will be journal. Clear? Okay. So thank you, friend. Just you go through the topic vividly. Any queries, I would like to request you to make comments over there, or comments in my Instagram, and also it will be shared to our Facebook, my Facebook channel. So go through vividly. Any query, any objection, any clarification, please be given. Thank you very much.